This video covers production costs and the supply curve. It's an important video. It sets the foundation for the next several chapters when we cover perfect competition, monopolies, and monopolistic competition. This video will provide a systematic way of analyzing a firm's cost structure. And what I mean by cost structure is, what are the firm's fixed costs? What are its variable costs? How do those change as output changes? And basically, you can think of cost structure mentally. You can just think of it as these cost curves that I'm going to show you shortly. Our ultimate goal in this chapter is not just to understand those cost curves, but to determine the production output that we should do. How much quantity should we produce? Q. What is our output decision? And then at that output point, say it's 100 units, what's our profitability? It could be that our optimal production point causes us to lose money, in which case maybe we want to shut down, maybe we don't. Maybe we want to shut down only for the short run. Maybe we want to shut down permanently in the long run. We're going to address those issues in this video. Along the way, we'll cover opportunity costs, fixed costs, variable costs, implicit costs. We'll look at economic and accounting profits, and so basic definitions to start the chapter off. We will take a high view of things with a production function, so we'll learn what a production function is, and a total cost curve. They're kind of like mirror images of each other, and it's a nice high-level introduction to the chapter after we cover those definitions. Then we want to talk about the short run. And it's really important to recognize when we are in the short run. We are in the short run when there are costs fixed. If there are fixed costs, that means we are implicitly in the short run. In the long run, everything's flexible, so you don't technically have fixed costs in the long run. So whenever you're dealing with fixed costs, we're implicitly in the short run. And what we want to do is, when we're in the short run, we want to look at this idea of diminishing marginal returns. Right here. Diminishing marginal returns. That's important. Now, I highlight diminishing marginal returns because the last couple of words after that phrase are usually left out in the chapter and most of the literature, and it's a little confusing. But it's diminishing marginal returns to the variable input, which in this chapter is usually labor. And so what that means is, okay, when you add a person, a laborer, a worker, you add a person, what happens to your returns as you add workers to it? That's what we mean by diminishing marginal returns. They tend to drop off. So the more over time, I shouldn't say over time, but as you increase and substantially increase the number of workers, we're going to have diminishing marginal returns to that variable input, which is labor. So that's important to recognize. We'll look at per unit total and average costs. We're going to look at a lot of cost curves. They'll look the same, but I hope that you actually write them down, work with them. Just don't look at them, but actually draw them out. See if you can draw them out by memory. We'll look specifically at marginal costs because an important component of this chapter is marginal analysis. And what we mean by that is, for example, what happens to profitability or your costs if you, on the margin, increase output by 1 unit? Or what happens if you increase a worker? You go from 1 worker to 2 workers, 2 workers to 3 workers. What happens on the margin to your costs and profitability? That's what we mean by marginal analysis. Then we'll look at long-run average total costs and the concepts of increasing, constant, and decreasing returns to scale. Concepts you've probably heard of. You have an intuition for them, probably, but we're going to define them carefully in this chapter. And when we're talking about increasing, constant, and decreasing returns to scale, we're in the long run because everything's going to be flexible. So we'll do that. Now, we're going to let's start off by looking at some definitions. First off, implicit costs. Implicit costs do not require a cash outlay. They're different, obviously, than explicit costs. We're all used to explicit costs. You have to write a check or you have to actually pay cash, and it's measurable, easily measurable and obvious what an explicit cost is. But an implicit cost is you don't require a cash outlay. Nevertheless, it's a cost. to you. Now, a couple of examples. If you own a commercial property that could be rented, but you don't rent it, that's an implicit cost. You could have earned that rent. An implicit cost also would be, for example, the lost salary from going to college. Again, you don't write a check out for that lost salary, but nevertheless, it is a cost that you should factor into your decision. We'll also cover opportunity costs in this chapter, and we'll use that concept. And an opportunity cost is what you must give up to get or keep something. And so an opportunity cost of college, for example, is foregone salary plus the cost of tuition and school supplies. So that would be the opportunity cost. So there you can see right away that opportunity costs can include implicit costs. And at the bottom of the slide here, I say, look, opportunity cost is the sum of explicit costs plus implicit costs. The opportunity cost of not renting a commercial property is lost rent plus the actual cost of upkeep of the property that would be taken care of by the renter. So, which would be an implicit cost because you're not actually writing out a check for, say, the renter is cleaning up the, maybe painting some areas or cleaning up the parking lot, keeping the place in working order. Those would be implicit costs that should be recognized. Let me be clear here. To make the situations comparable, if you do not rent that commercial property, you have to make the assumption that you're going to have to write a check and have an explicit cost associated with the upkeep of that commercial property. Now, next we'll look into fixed costs. And fixed costs are costs that do not change with output, Q. So when you change quantity of output, it doesn't change. And that's rent. Okay? So rent is a fixed cost. And, again, we're talking in the short run when we're dealing with a fixed cost. Now, the implicit salary of a bakery owner, for example. Now, let's think about that. The implicit lost salary of a bakery's owner is a fixed cost because, look, you got one owner, and no matter how much output you produce, the costs are the same. That implicit salary is going to be the same for that owner. Again, if we're looking at fixed costs, we're dealing with the short run. Now let's look at variable costs. Variable costs, by definition, change with quantity, our output, Q. So the cost of flour and sugar in a bakery, well, they're going to be variable costs. Even the number of bakers, in other words, the number of laborers or workers, is variable. At least in the problems that we're looking at, they're going to be variable. Now, we also need to distinguish between economic profits and accounting profits. Economic profits would include the implicit opportunity cost of lost rent in the commercial property example I gave you, while accounting profits would not reflect this cost. Also, if you invest $100,000 in your business, the implicit opportunity cost is the lost interest income from a similar investment. And the lost returns from a similar investment, assuming the same level of risk. Now that I've covered the introduction, gave you some definitions and some concepts to work with, let's go into the heart of the chapter. Look at production functions, total cost curves, and basically a table of all the various costs of a firm. This is where cost structure comes in. We're basically looking at the cost structure of the firm. So here we have a bakery, and we're looking at its costs per day. This bakery produces cakes. It's a little contrived, but it's designed that way to simplify and make as clear as possible the concepts that we want to illustrate in this video. So the first thing we want to see is, look, we've got a table on the left of numbers. That's the cost structure in tabular form. So the first column here is labor. That's the number of workers. We can go from 0 workers up to 5 workers. The second column, which is the output, cakes, quantity, Q. And that starts at 0 cakes. Obviously, if you have 0 workers, you have 0 output. And then with the first worker, you get 40 cakes out of the first worker. Then you hire a second worker and you get 60 cakes, 60 out of that second worker, a bit more. And then the third worker only produces 30 more, and the fourth 20, and then the fifth only 10. So right off the bat, what you're seeing is what we call specialization, the effects of specialization. If you have one worker in a bakery, let's say it's a retail bakery, you got somebody working, that individual has to work the cash register, deal with customers, deal with various orders, bring in the raw materials, bake, obviously, and that takes quite a bit of time. And so they're kind of stretched out a bit, super multitasking. Now, if you hire a second worker, then you can have one specialize and working on the cash register and customers, and the other one specializing in baking, and you can get a lot more out of people if you can allow for specialization. But as you add more and more workers, they start to overlap each other, and if you have a confined fixed space, and so if your retail area of this business is fixed, then they're kind of running into each other effectively, and so their output kind of drops off. So that's why you're seeing output here dropping off as the number of workers goes up. So early on, you're seeing the effects of specialization when you see more output for each worker, and then you start to see declining output. That's called diminishing marginal returns to labor. So labor is your variable input. There's a fixed, now I'm not saying fixed cost, a fixed space constraint here, and that's the size of your floor plan, basically, of this bakery. And so because of that, each worker's, as you get further up in quantity and workers, you're going to have each worker produce less. That's diminishing marginal returns to labor, that variable input. And when that happens, we're looking at things in the short run, because in the short run, that floor space is fixed. Now let's look here at the third column. We have rent, and that's rent is the cost of $200 a day. You can think of that as it's a fixed cost. It's fixed for the floor space. And also you can think of it as fixed for the equipment that's there. And that's what the rent is being paid for. It's $200 a day, doesn't change. The variable cost is $250 per worker. That is constant. So every time you hire a worker, it's going to cost $250 per day. Then we have total cost, which is fixed cost plus the variable. And it's important to note right here with 0 workers, even with 0 workers, your total cost is $200 because you still have the fixed cost. No matter what, you're going to have to pay that rent, even if you don't have any workers. And then your total costs ramp up, as you can see, which makes sense. Now what we want to do, and is going to be convenient when we do our analysis, is we want to look at things on an average basis. We want to look at average fixed variable and average total costs, and those are the next 3 columns. And right off, let's look at column 6, which is average fixed costs, and you can see that the average fixed cost, which is fixed $200 divided by 40, is $5 per unit when we have 1 worker. And then as we go down, the fixed costs get spread out amongst more units. And so this is fixed cost divided by quantity as we go down here. And so fixed costs get spread out, which is that makes intuitive sense. Now let's look at average variable cost. And average variable cost starts out at $6, that's $250 divided by 40 units. $6.25, and then it drops down, and then it comes back up a bit, and then it keeps popping up again. Okay, you're seeing the effects of diminishing marginal returns to labor, because every increment of worker you add $250, but your costs effectively are going up. Initially, I should say they're coming down. That's the effect of specialization, but then they're ramping up. Now let's go to the average total cost, and again you can see this reflects all of the cost, which is why it's an important column. It starts out at $6.25, drops to $7. That's the effect of specialization, and then the diminishing marginal returns to labor start to overwhelm things. Overwhelms the effect of specialization. Now the last column is a very important column, and this is where the marginal analysis comes in. We're looking at marginal cost. And right out the bat, notice that marginal costs are in between the number of workers. It's in between 0 and 1, 1 and 2, and 2 and 3 workers, as you can see down the line there. Marginal cost is your change in total costs divided by your change in quantity. So we went from 200 to 450 in costs, so that's a $250 change in total costs. Output changed by 40, and that's going to turn out to be $6.25. That's your marginal cost for an additional worker. And as you can see, your marginal cost drops down, then comes back up again. That's important to see. On the margin, what happens when you hire a worker? What's it going to cost you? You can see that it drops down and goes back up. We'll graph that in a moment or two. So what I've done here on the right here is I'm showing you a production function, a high-level analysis, where, as I say, be careful. Make sure your x-axis here, which is workers. So here we have workers here, and here we have output here, cakes. And so it's equally spaced, 0, 1, 2, 3, 4, 5 workers. And see here you can see the production function ramping up. And initially what happens is you can hardly see it, and I'll exaggerate it when I draw it with marker. A little dip here, and then like an inflection point, and then basically you see this production function dropping off. That's the effect of diminishing marginal returns to labor. Because if labor was just as productive, if the 5th worker was just as productive as the 1st worker, it'd be a straight line going up. But as you can see, it tails off. Now let's go down and look at it from a cost perspective. And so here we have costs, same bakery, same data. I rearranged the columns just a little bit, and I highlighted it for you. So quantity is in the first column, and total cost is in the second column now. And so it's the same data, but the point is I took at the total cost curve on the right, shows, look, here is the costs ramping up. They're flattening out a little bit after 40 and coming up. And this is the flip side of that production function I just showed you. So as the quantity of output, which is on the x-axis here, increases, and make sure that's all equally spaced so you can get this curvature. And then you can see the total costs ramping up. The total costs are ramping up because each worker costs $250. It's constant, but they're not getting the same amount of output out of each one. So your costs are going up on a per unit basis. Now, let's look at things from a marginal cost perspective, and that's the next area here. So it's the same data, and so I rearranged the columns again on the left, as I have highlighted. But what I'm showing you here now is, look what's going on with marginal costs. So marginal, and it's not quite drawn the way I'd like it to draw, because it's kind of hard to draw this in an Excel spreadsheet. But technically, these points should be in between the 0 and the 40, in between this area. It should be in the middle. But what you see here is your marginal cost. As we get more output in this direction, our marginal cost comes swooping up, drops off, sometimes called the Nike swoosh, and may be hard to see, but I'll exaggerate it when I draw it out with a marker. Now what I want to do is interrupt the video and have you do some analysis on your own. So here I'm giving you the same information that I showed you in the Excel spreadsheet, and I have labor, quantity, fixed costs, and variable costs. The givens that I told you. This is what's typically given. And what I'd like you to do here is to fill out the rest of the table. Notice I didn't give you the headings. You should figure out what those headings are. You should be able to figure out how to do the calculations. The calculations are pretty straightforward, and then you ought to be able to graph it. It's a really good exercise because when it's done on an Excel spreadsheet, it looks easy. In fact, too easy. You'll be deceived by some of the complications that are involved. And it's really not that complicated. It's just a matter of getting used to, like anything else. Now I want to draw out the cost curves so you can visualize what's going on here from that table. Now I'm not going to use the actual numbers from that table. It'd be kind of tedious for me to draw that out on a video. So I invite you to do it on your own after you watch what I'm doing here. So notice what I have. I have costs up here, because I'm going to have graph out the marginal cost curve and the average total cost curve and some other curves here. And I have quantity here. It's important to recognize that I have these units equally spaced. Now I got 1, 2, 3, 4, 5 units, and so on. This could be 10, 20, 30, 100, 200, 300, but they're all equally spaced. Each unit gets an equal amount of space on that x-axis. And again, here we have the costs. And so what I've graphed out is, in general, what an average total cost curve looks like. First, it's pretty high, and then it drops down to a minimum, and then it swoops back up here. This is high initially because of the high fixed costs. So you got fixed costs really spread out by a few units here, and in this case 1 unit, but just imagine it's a continuous number of units. So we have high fixed costs, and then eventually the fixed costs are spread out amongst more units, so your average total cost curve comes down. But it's also, remember, there's the effects of specialization. And you can see the specialization because my marginal cost curve is coming down and going up. Okay, that's a sign of specialization. Now, a lot of textbooks will show you this graph, and those will show you a straight marginal cost curve. And that would reflect a situation where there is no specialization. But in most cases, specialization is empirically relevant. And so I'm drawing it in there with just a little bit of extra effort to put the curvature in there. What's important to see is that when the average is above the marginal, then the average is coming down. And what that means is, look, when on the margin, your costs are low, it's going to pull down the average. Okay? And so as long as the marginal cost is below the average, up left to this point, it's pulling down this curve. And as soon as the marginal cost starts going above the average total cost curve, the average total cost curve starts going up. It's just like your GPA. So if you have a GPA, which is your GPA versus your a grade in an individual course. So you have a GPA, and that's a grade point average for all the classes you've taken so far. Then you add another class to your transcript. And if that grade is below your GPA, so your GPA is a 3.0, you get a C, and that's a 2, that's going to pull down your GPA. And so long as your grades of your individual courses are below your GPA, it's going to pull down your GPA. There's a point where it's going to intersect. And that's when marginal costs start to ramp up above average total cost in this example, or when your grades get better than your GPA, your individual grades as you move through your schoolwork. Now, what's important here is that notice this marginal cost curve cuts the average total cost curve at its minimum. So from an economics perspective, this is what's called efficient scale. The minimum average total cost, which is right here where it intersects with the marginal cost curve, is sometimes called the efficient scale. And what that means in English, scale means size typically, and you can measure size in numerous ways, but often quantity of output that's produced by a business is scale. Okay, so that's what scale means, it's size. So this is the minimum average total cost curve. It's the efficient scale, the efficient size for the least cost on average. So we're right here. Okay. Now, keep in mind that when I'm drawing this, that the margins, right, the margins fit between. They fit between these points when you graph this out. And that when you're doing the averages are right on the units. Just as an aside, so when you graph this on your own and you try it, it takes a little bit of trial and error to get used to it. But nevertheless, it's a valuable tool for you to learn. Now, what we next want to do is let's look at average variable costs. And average variable costs are going to look something like this, roughly. Let's see. Average variable cost. And the way I drew it kind of carefully. It's again, takes some practice to get there. But what I'm trying to do, what I attempted to do here is, if you look carefully at this midpoint here, your marginal cost and your average variable cost will equal out. It was the 625 per unit that we had in the table. Okay, so these start out at the same point. And the other thing I want to do is, have quite a bit of distance here, and then this distance shrivels up as this average variable cost curve almost approaches the average total cost curve. It does after a while. And what that reflects is this is your average fixed costs. Your average fixed costs are high, and then they start coming down. So if I was to draw an average fixed cost curve, let me find a pen. I want to do it real thin here. If I wanted to do that, I would have an average fixed cost curve that did something like this. It would just come down. So I don't want to muddy up the picture too much with that heavy curve. So that would be your average fixed cost coming down and down. And it comes very thin here, and it matches up with this. It's kind of thick here. It matches from here to here. It matches this difference. Now, let's take what we've learned about average total cost curves and apply it to a thought experiment. So in this thought experiment, we have costs on this axis, and it'll be average total costs over the long run and over the short run. Here we have quantity of output. And so let's imagine that we have a relatively small firm, and here's its average total cost curve. We'll call it ATC1. This firm is relatively small, and so it'll produce output. Its minimum efficient scale, its point where it should be producing for a minimum average total cost, is right here, relatively small firm. So this is his average total cost curve. Now, imagine if this firm could get bigger and you could relax the fixed input constraint. So in the bakery example, it was floor space. In a farm, it's kind of the same thing. It's the acreage that's fixed input that you run into constraints on. So imagine you could relax that. And if you could relax those constraints, those fixed input constraints, you'd have a minimum average total cost curve, or an average total cost curve that looks something like this. And so you'd have a larger scale plant. So this would be a small scale plant, small. This would be mid-size plant. And then you know where I'm going. I'm going to a large in a minute. But so here we have the effects of specialization from a bigger plant. You got more open space. You can have more specialization, and then you could spread out fixed costs amongst more and more units. And then let's say we could have a bigger plant, and so this is the average total cost curve for 3. We'll call this 2. And so we have a minimum average total cost up here somewhere. Assume that's the minimum of this curve, not drawn too well. But okay, so this is a large plant. And so these are short-run average total cost curves, just like we saw earlier. And why are they short-run? And this is an important point. These are short-run average total cost curves because they're constrained by a fixed input. Okay? When you can relax that fixed input, you're in the long run. And so imagine this firm growing over time and alleviating that fixed input, the floor space on a bakery or the acreage of a farm. And what you'd have is what we call a long-run average cost curve that does something like this. And so we have a long-run average total cost curve. And so what you'd have here is you'd have what's called increasing returns to scale, which comes about primarily from specialization, and you're going to get some spreading out of fixed costs. You're going to come to a relatively flat spot, as best I can draw here, and that's going to be called constant returns to scale. Your costs are not changing in this. Your minimum average total cost is not changing as this thought experiment of increasing the size of your business over time. And then eventually, look what happens. Costs start to ramp up. Now, why could that be? Well, that comes about through unwieldy businesses. If businesses get too large, they get unwieldy, hard to coordinate, and their costs start to go up. And that's called decreasing returns to scale. So that's not unusual. It explains why a lot of businesses don't get bigger and bigger and bigger. And the reason they don't get bigger and bigger and bigger, in a lot of cases, they run up against this problem of decreasing returns of scale, hard to coordinate their business. It's too unwieldy. Now, don't underestimate the value of this concept. I'm applying this to a manufacturing plant, like a bakery. You can think of a bakery as manufacturing baked goods. You can think of it as applying to a farm, but it even applies to a more abstract concept, more abstract business, such as mutual funds, which are investment companies. So I teach investments often, and in there, if you study investments, you study mutual funds, and you look at various mutual funds and their performance over time and their size. And what you will notice is that some mutual funds close their doors, so to speak, to new shareholders. So these funds get bigger and bigger, and keep in mind when an investment company gets bigger and bigger, it's usually because its returns are really good. So, a mutual fund is a portfolio that's managed professionally. You send your money in, and they professionally manage your money for you. And if the returns are really good, the business expands. More shareholders start pouring their money into the mutual fund. The portfolio managers have more money to invest, and they got more and more money to invest, and they're scouring the world. First they're scouring the United States for good investments, and then they pretty much run out of good investments, and they go around the world. And so they got to start hiring international analysts if that's part of their strategy. The point being is that these investment companies sometimes get so big that they run into this problem of decreasing returns of scale. Because what happens is when they start having to hire international analysts to find and scour the world for good investments, their costs start to go up. They get unwieldy. So what these investment companies do in order to keep their costs low and their returns high for their shareholders, because if you have high costs, it means lower return for shareholders. And so these investment companies close their doors to new shareholders. They'll keep the same they'll allow shareholders to invest more, their current shareholders, but they just won't open their doors to new shareholders. And the point is they're trying to maintain at least this area, so it's hard to measure. In most firms, this is pretty hard to measure, but in the mutual fund industry, this is not hard to measure because you can see what their average cost per dollar invested. So you look at their average, which is their expense ratio, and you can tell from their expense ratio. So you can see that some firms that are getting larger have a lower expense ratio. They're finding good opportunities to invest in, but eventually costs start going and ramping up, and they get diseconomies to scale. So if you've been following the discussion so far in this video, you might ask, well, where's that supply curve that you promised in the video? The title of this video is called Production Costs and the Supply Curve, and I haven't even talked about a supply curve. Where is it? Well, that's what I want to talk about next, and it'll lead us into the next chapter. Well, the next several chapters, in fact. It turns out that this curve right here, and you should recognize it, that's not quite U-shaped. There's a U-shaped component to it, but it's not U-shaped. That's the Nike swoosh. That's the marginal cost curve. It turns out that this cost curve is going to be, or at least a part of this marginal cost curve will be the supply curve of a company. And it will depend on some factors I'm going to bring in a second here. But so far, think about it. I've covered cost curves, a whole bunch of different cost curves. And, the best we could do with that is say, in terms of optimization, was to compute an average total cost curve and come up with the minimum, right? The minimum of that U-shaped ATC, the average total cost curve. But that's not very satisfactory because we know businesses, they don't want to minimize costs, right? Because actually, if you just wanted to minimize costs, they'd be zero. So there has to be some type of something pulling firms to okay, they want to obviously look at costs, but they need to look at something else when making their decisions to optimize around profitability. And what's missing from this analysis so far is the idea of price. So here we have costs on a per unit basis. We can add price to this. That's where the next 3 chapters come in. We're going to look at competitive markets. We're going to look at monopolies and then monopolistically competitive markets. And those have price functions. They have demand functions. And what we're going to see is, this is going to be a supply curve for all 3 of those examples: perfect competition, monopolies, and monopolistic competition. Somewhere along this line is going to be the supply curve for the firm. And it's going to depend on where the price is. So that's the mechanism to keep us from, spiraling into the dirt with minimizing costs to zero, right? You're going to minimize costs, but you have to keep an eye on price, because firms maximize profits, which is not just looking at costs, but looking at the revenue that's associated with it, and marginal revenue, how price changes and the revenue changes with changes in quantity. So what we're about to embark on is, in the next chapters, we're going to add price to this graph, and we're going to assume perfectly competitive markets. And what's interesting about that is the price is going to be fixed. We're going to assume small firms. So a small firm can't control price, and so they basically have a demand function that's flat like that. Looks something like this. So here would be the price. And when you have a price that's flat, and that's the demand curve, because what it's saying is, no matter what, so you can sell as much as you want at this fixed price, and we're going to assume that in theory, then this is your marginal revenue and your demand curve all in one thing. And so what happens is we're going to maximize profits by equating this marginal cost to the marginal revenue. And I say marginal revenue because, look, if you change quantity by 1 unit, you're going to change your marginal revenue is just simply P. And so what will happen is we're going to look carefully at setting marginal cost equal to marginal revenue and determining and seeing where that fits on this supply curve. And it turns out if price goes up, firms will supply more, and if price goes down, they'll supply less. But there's a bit more to it, It's a little more involved. So the point is, we got these cost curves, and by themselves they're interesting, but it's an incomplete picture of the story. We need to look at price, and when we look at price, what we're looking at is a demand curve. What do those demand curves look like? For perfect competition, the demand curve looks like this. For a monopoly and monopolistic competition, there's an element of price control, and there's a downward sloping demand curve, and we're going to have a downward sloping marginal revenue curve, and we need to optimize to figure out where is the best profit, where's the most profitability coming from, where. And then we'll find out that this marginal cost curve is the supply curve, but only in certain portions of this marginal cost curve. So a really important part of this chapter that bleeds over into the next 3 chapters, is the concept of marginal analysis. Look, comparing marginal cost to marginal revenue. That's what we mean by marginal analysis. And what that does is it determines Q as being the optimal output. Okay? So then you determine Q. That's the first thing you need to do. And then the next thing you need to do is you need to determine, well, where are your costs at that point to determine profitability? And so you determine Q with the margins, and then the average TC, average total cost, will help determine your profitability. Because, look, if your average total cost curve comes up something like this, right? Your costs are greater than the price, and you're not going to want to produce. So that's where averages come into play. Averages determine profitability, but before you determine profitability, you need to know quantity. Quantities are determined by marginal analysis.